Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking.
Ready?
Welcome back.
Welcome.
So today, again, another topic.
Another
Ryan
episode.
special.
Yes, another.
I guess Ryan's so excited.
I know. Yeah.
Yay! Talking about an article that Forbes put out regarding Trustco Bank offering a new program, and this is really just specific to people who already have a loan with Trustco Bank, correct?
Yes.
Okay. New mortgage program that offers below market rates to their existing borrowers with a new split the difference program. So I read a little bit about it. Tell us about what you think about this.
What I think about this and where this is going. So this is an interesting topic for from a product standpoint, from a lending product standpoint, right? The biggest challenge that we are facing right now as an industry is just the affordability aspect of things, which is a direct result of higher interest rates, right? And that has, certainly made it more challenging for people to qualify. So what the problem with certain mortgage banks, mortgage lenders, banks as a whole, they have this portfolio of low interest rate loans on their books. And the challenge that we're seeing right now is that a lot of these people who own homes with low interest rates, they want to move, but financially, when they look at it, they're like, why would I? You're going to have a 3% mortgage. I'm going to go to if I go to an 8% mortgage, my mortgage payment's more than likely going to double for the same amount of money that I'm borrowing or that I originally borrowed. But you're typically borrowing more now because the prices have gone up, so your payment is going up more than double. So it's a really tough situation right now. So this is what was interesting about this article, and we just happened to stumble upon it, right. Was this Trustco Bank is putting out a program where if you took out a mortgage with them during the last couple of years, and it was a low rate mortgage, so let's say
3%.
Let's say you took out a 3% 30-year fixed mortgage. Awesome rate. But maybe at the time you were single, or maybe you were just married, no kids, but now several years have passed and now your life has changed. And now you need a bigger home. But you don't want to give up a 3% mortgage and go to an 8% mortgage and have your payment double, right? So what Trustco came up with, which I think is amazing, shout out to Trustco, great job. No, it really is. Like, this is a really
sponsored by Trustco.
Yeah, no, but it's a really creative product, and I love that that innovative mindset here with this, because it solves several problems. There's also some other issues that it brings up, but that's more for back office conversation. Right. But what they've done is they've put out a program now where if you took out a mortgage with Trustco, this is solely isolated to them. If you took out a mortgage, low rate mortgage, you can now go get a new mortgage with them, and they'll split the difference. So it's really simple. 3% mortgage that you had previously, let's say a new mortgage today is 8%. They've come down a little bit, but let's say it's 8%. So you have a 5% interest rate spread there. They'll meet you halfway, meaning that they'll give you 2.5% lower interest rate. Your new mortgage rate will come up 2.5%. So you'll have a 5.5% 30-year fixed mortgage versus an 8%, 30-year fixed mortgage. Right. And that solves two problems for them. One, it gets a low interest rate mortgage off their books, because what a lot of companies are struggling with right now is the value of these mortgages that they have on their books has gone down substantially, because the interest rates are so low that the value of the mortgage has depreciated. Okay. The other thing that it does is it now gets them into a higher. It shifts their portfolio around a little bit, where now they get rid of the low interest rate mortgage. They bring in a more market type of rate at 5.5, which is ultimately where I think rates will wind up being anyway. So it gets them into a much better situation for them as a lender. And it obviously helps your borrower too. It solves multiple challenges in our industry right now. And again, kudos to you guys for the innovation here, because it's a fantastic product. It stinks that it's only isolated to them because they're a portfolio lender. Right. They own the mortgage. They're the only ones that can do it. And their client base is we're not talking about millions and millions of homeowners here. It's a small client base, but I love the fact that some peers in our industry are trying to innovate a little bit, trying to come up with some solutions that have some teeth, that can actually help with solving the inventory problem that we have, and solving the interest rate problem that has become huge. So I don't know, it checks off a lot of boxes, although there's some of the back office stuff like I was telling you about that could have some challenges if they're doing bonds and they're doing some other things. But overall, great product, and I love the idea of somebody being able to do this.
Do you think that other banks are going to start opening up this type of product? I mean, I don't know if they already started this, but I didn't really see a start date on it, or if we're going to see other portfolio lenders rolling this out.
They're definitely having a conversation about it.
Yeah.
They're definitely having a conversation about it, because the biggest challenge that these portfolio lenders are going to run into, not today, but when rates start to come back down, they're going to have a runoff.
Yeah.
All these high rate loans that they've put on their books, they're going to refinance off. Mm-hmm. And they're going to refinance off to, a big mortgage aggregator, or a big mortgage lender, a Loan Depot, a Guaranteed Rate, Cross Country, whomever, right? They're all going to attack when rates come back down. So a lot of these portfolio lenders are going to see that runoff. Mm-hmm. And this is a way to combat that runoff, because as a lender, whether you be a bank or a mortgage company, and you're handling the servicing, you want to retain that servicing, because that's where you make money, right? Now we could talk about the dynamics of servicing. It's a separate conversation, but you want to retain that client.
Yeah, so, I think that's an interesting way to keep. I mean, it doesn't apply obviously to refinances or anything like that, just new purchases. But I think it's an interesting way to keep the clientele. I don't really know, and I feel like we see a lot of people who just purchase for the first time and then refinance a few years later, or they refinance within a short period of time afterwards. And even those clients, I feel like we see so few of them stick with the same lender. And I don't mean servicer, I mean they use a completely different lender for their next loan, even if it's within a few months.
Yeah. Well, part of that is the marketing mechanism that's in place in mortgage lending. I mean, look, at the end of the day, Jackie, there's so much money on the table for mortgage lending that a lot of these companies, a lot of these big mortgage companies, they have these call center operations that their sole job is either to retain the client that they have for servicing. And because they have the servicing doesn't mean that they originated the loan. Right? So they want to retain the servicing, and they want to retain that client. So or you have other mortgage aggregators or mortgage companies that are actively going after, new clients to put on the books. So, that's why we've talked about this, the trigger lead thing. So as soon as you run your credit and you run it for a mortgage inquiry, bang, all of a sudden you get 10 to 100. At least.
10 a day.
Yeah, 10
Seriously,
a day.
It could be 10 a day.
More than that.
Horrible.
More than that. So, that just shows you how valuable the client is to a mortgage company or to a mortgage servicer or to a bank. Mm-hmm. And the fact that Trustco has come up with this program, it solves that problem. It solves a lot of problems in one fell swoop. You get somebody that wants to move, gives them the ability to move, gives them a decent interest rate, okay? And then it solves the problem of the runoff, because you're not going to, look, rates would have to come down substantially, 4.5% before refinancing really makes sense.
Right.
So you're going to prevent the massive runoff in your book from all these high rate mortgages. Mm-hmm. It's again, you laugh, and this is something that gets me up, gets me up in the morning, and it is, because it's so true, because something like this.
Ryan will text me the article, and then call me 2 minutes later. He's like, "Did you get my text message about the article?"
Oh yeah. Like,
I just opened it.
Well, because you know me, like I'll be up at like 5 o'clock in the morning reading news articles and go down a rabbit hole. Yeah. Well, totally. Oh my God, did you see this? But this was one of those things that was really, really interesting. I wish that the industry would adopt a better approach like this.
Right.
I don't think they will because there's so many other aspects of this. Like I was saying, it's tough to get into on a show like this, but the back office piece of this, not only the servicing piece, but also the capital markets aspect of this, and how it relates to the value of the bonds and where these mortgages are tied to, it makes it's a more complicated conversation for them to be able to do something like this. So this would really only apply to a portfolio lender. And
Right.
typically a portfolio lender is a small local bank or regional bank who owns the product. But that doesn't mean that you're not going to see, like, I could totally see like a PNC.
Doing this.
Oh, yeah,
Sure.
right. Like they're a regional bank, but this is a fantastic product for them. They have a decent client base. And for something like this, I mean, it would blow people out of the water. You just completely take over the mortgage industry in your respective area
Right.
with a product like this, because you would want people to. There are a lot of mortgages that are held by a firm like that, and they could immediately go to somebody and go, hey, you can do this, and we'll give you this rate. And
It certainly
fantastic.
gives a really nice incentive to mortgage bankers who, like, someone's like, oh, I'm going to use PNC because I've known this banker forever. You're seeing a lot less of that now. We're seeing more people are like, oh, I went with Chase Private Client or something, you know what I mean? Because I'm a Chase Private Client, like it doesn't really mean anything. But if you actually work for PNC or Trustco,
Everybody's Chase Private Client now.
right? Like I got
Apparently.
$1,000 in Chase right now.
Yeah,
I'm
yeah.
a Chase Private Client, but it is an interesting product for someone who's actually a banker who works there to be able to call their clients or people that they've met with and say,
Yeah.
hey, by the way, like I have this great product. I mean,
Yeah,
it's
yeah.
just a great reason to follow up with their current clients.
Yeah, just and that's the other aspect of it too. A lot of banks, one of the things that Wells Fargo did for years, and it was really, really good solution to their problem, was they were so competitive in the jumbo market, really competitive in the jumbo market, to the point where we as mortgage lenders couldn't even
Touch
come
it.
close to what they were offering. But they used that as a loss leader, so that they would hit you for credit cards, they would hit your checking accounts, they hit you for your investment accounts. They would really go after you, because obviously if you have a jumbo loan, you probably have other assets that we can tap
Right.
into, whether it be credit cards, other mortgages, auto loans, investments, et cetera. But it was a good segue into engagement with your client,
Sure.
and constantly being engaged with your client. And just think about something like this for a firm like that, or Trustco, even just Trustco. Like, I mean, that loan officer got wind of this and was on his phone.
Yeah.
I can't even imagine the
So
feeding
quick.
frenzy that went
So
on
quick.
over there. That these guys were like this. They were high-fiving each other in the boardroom. Like, this is going to be fantastic. I'm loving this. This is great. Calling all their clients. And guess what? I bet you they got a crap ton of business coming through the door right now, because they're that there are people right now that have a 3% mortgage that don't want to give it up, because they don't want to pay for 8%. It's not because they can't afford it.
Yeah.
They just don't want. Why? Why would you do that?
And even if this product was offered with a different lender, I think that people would still be more, and with maybe a little bit better incentive, people would be more likely to stay with the current bank that they have or with Trustco, because I think at the end of the day, it's certainly easier for people to have all their stuff or all their money and all their loans through one place. Like, imagine only having to deal with the same animal again, and not having to deal with a whole nother lender with a new person. And that's certainly part of the frustration for people in applying for a loan anyway, is it's just new people. I just want like one person, one point of contact. It's like if you have your guy, they call you up and they're like, hey, I got this great product. You're like, I was thinking about getting a bigger house, but the difference is so ridiculous. Like you said, you could be borrowing less money and you're paying more. And this is still a difficult concept for people to wrap their brain around, but I think it's great. I think it's really interesting. And we'll
that's
see what happens.
a lot of what's happening right now in the industry is they're trying. Like I'm seeing a lot right now where a lot of firms are offering refinances. Everybody's offering a refinance now for a reduced cost, which is cool. I get that too, but it leaves a lot of information out of the
Right.
discussion. Like, okay, well, what is your margin, right? Like, that doesn't equate to you getting the best rate, you know, and it doesn't equate to you getting the best costs either, right? You know, so it again, this Trustco thing, while it's isolated to them, great product. I think it really solves a lot of problems, and you know, I hope that a lot of other portfolio lenders adopt something like this, or at least try to innovate like this to try to help solve that problem, because we need to get more inventory, you know, into the market to stem off this, you know, this constant, you know, upward push in value. I mean, it's crazy. I mean, we're starting to see a little bit of it, but man, let's just make some of these homes a little bit more affordable for people. Like, geez, I mean, just not everybody makes $1 million a year.
Right.
You know, not everybody wants to be like, what's crazy right now, a lot of more, you know, years ago, maybe not even years ago, let's say like 5-6 years ago, like a normal mortgage payment would be, I don't know, $2,800, $3,000, $3,200. I mean, I'm seeing first time home buyers with like $5,000-$6,000 mortgage payments.
Yeah.
And I'm even me, right? I'm like going like, I wouldn't want that. Like, that's crazy.
I know.
You know, that just seems to me right out of the gate as a first time home buyer to have a $4,000, $5,000, $6,000 mortgage payment, $7,000 mortgage payment. Now they can afford it, but it's just such a big number relative to, you know, that's the other aspect of things. The mortgage payment has now become a substantially larger portion of people's income.
Debt.
Yeah. So it's good. I'm glad to see that somebody is trying to innovate.
We'll see where it goes.
We'll see where this goes.
All right. Until next time.
All right. Till next time.